Hey there, hope you're doing well today. So not all capital calls are defined the same, and in today's quick video we'll go into one subtle difference that is often misunderstood or misinterpreted by passive investors. But before we begin, just a quick reminder that our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. So let's begin. In a typical single deal, multifamily structure, or even syndication, when a sponsor purchases a specific assets or perhaps a small portfolio of assets, the capital is invested up front. The meaning of a capital call would signify an event where the property or the asset is going through compressed cash flow, compressed liquidity, and so the sponsor feels that it's necessary to raise additional capital in order to continue executing on the business plans and therefore protect the investment, at which point they will make that request for additional capital infusion. And how that is made and that is structured, how that is executed on, and what the consequences are for not contributing to one is all outlined in the operating agreement, which is part of the private placement memorandum, and we've discussed at length in prior videos as well as in some of our blogs. So if you'd like a copy of that, simply comment below. But there are situations where, as a passive investor, you may be investing in a fund. And so depending on how the fund is structured, capital call doesn't necessarily carry the same connotation or have the same meaning. In many cases, you may commit the capital you would like to invest up front, but you may not be asked to contribute all or part of it at once. Maybe you commit 50, the initial call is for $10,000, and then subsequently when an actual deal is identified to be added to the fund, you may be asked to contribute the other 25 and maybe another 15, for a totaling $50,000, which equates to the original capital that you contributed. So in that case, that's it. How that is done, when that is done, how that is executed again will be outlined in the operating agreement of the private placement memorandum, but it doesn't necessarily mean, right, the fund is going through liquidity or cash flow compression or distress situation. It just may be a function of the timing of when deals come into the fund and how the sponsor or the fund manager is choosing to manage the capital. You may ask, why would they do it in stages? Isn't there a risk? And there's definitely a risk. They may choose to do it in stages because they may not have a property identified, and unless there are provisions or stipulations where they're maybe paying you interest for holding on to your money for an extended period of time, they may simply decide to call when the money's really needed, and at that point really I'm counting on you as an investor to follow through with the original commitment. And similar to traditional capital call structure, non-compliance typically has consequences, and those are outlined in the operating agreement. So I hope today's video was helpful in demystify some of these or clarify some of these misconceptions or potentially misunderstanding that passive investors sometimes may encounter when they come across the term capital call. And if you found it helpful, please like, share, and subscribe, and I'll see you at the next one.